Good morning, good afternoon, good evening, wherever you happen to be in this world. This is John West with you back again for Japanese Business and Economy. Yes, as I said, John West back to you with Japanese Business and Economy. And we're going to commence Class 5. This will be Part A of Class 5. And we're looking at Japan's lost decades. Now, what we call Japan's lost decades, a period of weak economic growth, a period of economic stagnation, began with the bursting of the economic bubble in the early 1990s. That's something we covered in our previous longer session. Now, this bursting of the economic bubble, this started the lost decades, but the lost decades were made even worse by the decline of Japan's working age population from 1995, the aging of Japan's population. As we discussed before, we've had new competition from Korean and Taiwanese companies too. The Kobe earthquake in 1995 rattled the Japanese public and highlighted the fact that the Japanese government was not quite as competent as we used to think it was. A terrorist attack in the Tokyo subway, the sarin attack in 1995, also destabilized the country, along with government corruption scandals. So lots of things happening in Japan in that first half of the 1990s, things that began what we call the lost decades. Now, in many ways, Japan's lost decades continue to this day, right now, even if the Abenomics program gave Japan a boost. During the lost decades, economic growth slowed down to around 1% a year after previous decades much faster economic growth. You can see this in this chart, which goes back to 1985, and you see there that the period 1985 through to 1981, economic growth was around 4% a year in that blue line, the blue line for Japan. Then through the 1990s, economic growth slowed down quite a bit. And by the time we get to around 1995, it's already at around 1% a year. And so from the period around 1995 through to now, Japan's annual economic growth has been around 1% a year or less. And looking ahead, as economists calculate potential economic growth, we mean by that potential economic growth, the maximum rate that Japan can grow at over time is less than 1% a year. Now, the major factor behind Japan's slow economic growth during the lost decades has been the declining working age population due to the aging of Japan's population. In short, with less and less workers available to work in the economy each year, the economy is weakened. And you see this in this graph where the blue section is the working age population, and over time, from around 1995, the blue section gets smaller and smaller. And you can see in the chart also the green section, which is the elderly population, people above the age of 65, that gets bigger. Whereas the children, people under the age of 15, that gets smaller too. Now, through the lost decades, Japan's fertility rate has remained low during all this time. Fertility rate being the number of children that each Japanese woman has on average. And with the fertility rate remaining low through this period, this means the problem of Japan's aging population is not being solved. You remember back to our earlier classes, the key problem, the key factor behind Japan's aging population is the low fertility rate of less than the replacement rate, less than 2.1 children per woman. So this low fertility rate continues, and there's no sign of that changing. Now, this is a very interesting chart, and I'll have to explain it to you. What this shows, in fact, is that Japan's per capita income its per capita GDP, fell from being near the top half of the OECD countries to being only around 80% of the top half of the OECD countries. You see this in this red line. The red line in 1990, it's around 90, 92 maybe. It goes up to around 95. It's around that for a few years. Then it slips down to 80. And so this red line shows per capita income or per capita GDP of Japan compared with the top half of OECD countries. OECD countries being the world's advanced countries. So Japan, through this lost decades period, has been falling backwards compared with the world's advanced countries. You also see in this chart another very interesting line, which is the blue line. This is labour productivity. What we see here is that Japan's labour productivity has always been much less than the top half of the OECD countries, much less than the leading countries. And it's around just 75% of the top half of OECD countries. So another way that Japan could become richer as a country would be to lift its productivity. And this is something we're going to look into in some future classes. So Japan slipping backwards in terms of GDP per capita compared with the world's leading countries, and being quite a bit lower in terms of labour productivity. And so this table, again, is very interesting because this shows us the world GDP per capita ranking. And we see that the richest countries in terms of GDP per capita, how much each person is producing, the productivity of our economy. Luxembourg is number 1, Switzerland, and then the United States comes in at number 7 after those smaller countries. Then Singapore, Australia number 10, Hong Kong number 14, Germany number 17, France, UK 2021, then Japan only comes in at number 23. So Japan is not leading the world when it comes to GDP per capita. Japan is just at the middle, really, of the world's advanced countries. It's a rich country, prosperous country. It's not a poor country. But it's only really in the middle of the world's advanced countries. And Japan really could and should do much better than that. Now, looking ahead to the year 2030, this chart shows us not GDP per capita, it shows us total GDP. And so total GDP is GDP per capita multiplied by the population. And you see, if we compare the year 2016 and with the year 2030, China will jump from being the world's second biggest economy to being the world's biggest economy, overtaking the US. The US will remain number 2. And Japan, which was number 3, is number 3 today, will slip back behind India. India has again an enormous population. If India keeps growing as it has in the recent past, it will overtake Japan to become the number 3 economy. Japan would be the number 4 economy in the year 2030, but Germany and the UK are not far behind it, and they're catching up. And so Japan's situation, where it has an aging population and low productivity, is not good for Japan for its future. Now, you may ask me, what is the importance of total GDP compared with GDP per capita? GDP per capita is how much GDP each person is producing on average in a country. So it's really the productivity, the efficiency of a country. It is also an indicator of the standard of living, because the more we produce, the more we can consume. Total GDP is a totally different thing altogether, but it's very important in many ways. Firstly, a country like China with a very big GDP can use that GDP to invest in its military. You know, a country like Singapore, which is very rich in terms of GDP per capita, only has a small total GDP because it has a small population. Singapore could never have a big military, could never be a military power. China, with a big total GDP, can invest a lot in its military and become a world power in that way. China can use its GDP also to influence other countries by investing and lending money. And China also, by having a big total GDP, it has a big market. And so other countries are very interested in selling into China's market. And China can use this market as leverage against other countries. So total GDP is a very important thing to look at. It doesn't tell us everything, but it's important. GDP per capita is also important too. They are two different economic variables with different interpretations. But the bottom line for us studying Japan in our course is that Japan will be moving backwards unless something happens. Now this chart tells us a similar story about Japan versus China. And as you see in this chart, I mean, if you go back, in fact, even 200 years, Japan was ahead of China in terms of total GDP. And I think it was around the 1700s that Japan overtook China and remained ahead of China right through till the year 2010. And China has now overtaken Japan since the year 2010. And as you see in this chart, China will be going way, way ahead of Japan, looking ahead in time. And so Japan has a higher GDP per capita, it's more productive, it's more efficient, the standard of living is higher, but China has this big total GDP, and it can use that to invest in its military. And of course, the attractiveness of the China market is very important for Japan, because Japan's own market is only growing slowly because of its aging population. Now, a defining feature of the lost decades has been the rise in what we call irregular work. This is a trend in most countries, but it's very marked in Japan. Now, irregular work, we mean short-term work, casual work, contract work. In other words, irregular work is not like a normal career. You just have a job for a short period of time. You don't have a career in a company where you might climb the ladder and stay in that company for your whole career. And so a growing share of irregular work from, in 1984, 15% to now close to 40%. And in the same vein, the share of lifetime employment jobs has declined in Japan. It's now harder and harder for students to get a job coming out of university and work for a company like Toyota and stay there for their whole career. Now, following the financial crisis, companies need greater flexibility more than loyalty. So they're keen on having a smaller number of people with lifetime employment and a bigger share of people on short-term contracts who can be hired and fired flexibly. And also, after the financial crisis, many companies needed to cut back on their employees to reduce their debt. So a very defining feature, the rise in irregular work. Now, one consequence of this rise in irregular work in Japan has been a rise in poverty. You know, many people don't think of Japan having poverty. Many of my students are shocked by when I mention poverty in Japan. But as you can see in this chart from the OECD, this chart shows us relative poverty of OECD countries. And Japan is actually has the fourth highest rate of poverty after Mexico, Turkey, and the US. And of course, as what's happened is with this rise in the number of irregular workers, the irregular workers have a lower salary than regular workers. And irregular workers sometimes jump from one job to the other. Sometimes they're in and out of work. And so they have lower income. And so this has given rise to growing poverty in Japan. There's something also that is important to bear in mind with this growth of irregular workers. If you have a lifetime employment in a big company like Toyota, you benefited from in-house corporate training. Now, this benefits the company too, because you're more productive, but it also helps you because you become more skillful. But people on irregular jobs don't get this in-house corporate training. And so maybe the companies think this is a good idea to just hire and fire people and not train them. But for the country as a whole, it means that there's a whole bunch of people who are missing out on training and education. Another thing which is happening is that today, many people who have these irregular jobs are overqualified for their jobs. So this means a great waste of human resources and lower productivity than otherwise. Very important trend, this trend of irregular workers. It happens everywhere. Maybe Japan is worse than many countries. Companies like it, but for the people involved who have the jobs, it's not always a good thing. And for the country as a whole, it's bad if we have people who receive much less training and education. Now, another feature of Japan's lost decades has been deflation. Now, it's very important to understand what deflation means. Deflation means falling prices. And you can see here on this chart, there's the line with zero. That's above zero, it's positive inflation. Below zero, it's negative price movements, falling prices. And you can see there in that period around 2000 and around 2010 and so on, there was periods where we had falling prices, deflation in Japan. And when I talk to my students about deflation, falling prices, they think this is great. If prices are falling, things are cheaper. But what happens actually is that when prices are falling, consumers often postpone their purchases. And this actually weakens the economy if everyone is postponing the things that they will buy. Deflation also increases the real value of debt. And this is a problem particularly for a government like Japan with such a big debt. Now, for example, if you borrow $1,000 and you have a debt of $1,000, that debt is just fixed there at $1,000. If there is deflation, prices going down, this also probably means that the value of your salary is going down. And so you have a smaller and smaller salary to pay off the debt. And so deflation has a negative effect increases the real value of debt and makes debt into a bigger problem. And at the level of a country, a level of a government like Japan, when you have deflation, you have actually lower growth or even falling amounts of tax revenues because prices are going down, salaries are going down. And so even if we just kept the amount of our debt fixed over time, with deflation, the real value of that debt actually gets bigger because government revenues, tax revenues are lower because of falling wages and falling prices. Now, through the lost decades, another trend has been that Japan's public debt, government debt, has grown to become the world's highest. And it's a problem that hasn't really been seriously addressed. Have a look at this chart here. You'll see that Japan's government debt is approaching 250% of GDP. This is extraordinary, almost 2.5 times the value of GDP. Many Americans are worried about the size of its government debt. It's around about 100% or so of GDP. Japan's is 2.5 times bigger. And so, and European countries like Germany, Britain, and so on, they're worried about their debt too, but they're well below 100% of GDP. So Japan, world champion when it comes to government debt. But you don't want to be a world champion when it comes to government debt, let me tell you. Now, how did Japan get into this debt problem? Now, this chart here that goes back to 1990, it tells us the story. And if you look at the blue line there, this shows us government revenue. Now, through the period from 1990 through to 2015 or so, government revenue has been weak because of the lost decades because of the weak economy through this whole period of time. With a weak economy, people are earning less income, companies are making less profits, and therefore the government is getting less revenue. Against that, government expenditures have been up. And in the initial period, government expenditure, the 1990s, the government expenditures went up because the government was spending money to try and stimulate the economy, spending money often on infrastructure, but other things to keep the economy afloat. But then as we move forward in time, the government was also paying money to its aging population for healthcare and for pensions. So the government really is in a difficult situation where the lost decades have kept tax revenues low, and the weak economy and the aging population have kept expenditure high. This can't go on forever. The government must do something about it. Now, another trend through the lost decades, and a little bit before also, is that Japanese companies have made big investments in the US, in Europe, and in Asia. Now, they've done this for two reasons, actually. Firstly, with the Japanese economy being weak through the lost decades, companies are looking for other opportunities for making profits, for doing business. And so, particularly in Asia, the markets are very attractive because countries like China and Southeast Asia and India, they've been fast-growing economies, lots of opportunities to make profits and to make investments. So Japan has been investing, Japanese companies have been investing a lot in Asia. But also they've invested a lot in the US and Europe. Partly that was because of protectionist pressures in those countries. US and Europe were worried about Japan exporting so much that they said, please come and invest rather than exporting. So Japan has exported a lot to these parts of the world. And so at the end of the year 2019, the total amount of outward foreign direct investment of Japan was $1.8 trillion, representing 35% of GDP. It's an enormous amount of money that Japan has invested in other countries. And so 35% of GDP. So Japan is a major player when it comes to outward investment. This is an interesting trend because over the last 20 or 30 years, the Japanese economy has been weak through the lost decades. But Japanese companies have not always been weak. Many companies are very dynamic because they've gone to other countries, they've invested in other countries, and some Japanese companies are doing most of their business outside of Japan. We're going to look at this a little bit in a bit more detail on a future class, but this is an important trend. But the sad part of the investment story is that the stock of inward foreign direct investment in Japan is only low, only $220 billion, or 4% of GDP. We've discussed before that doing business in Japan is a bit difficult. And so foreign companies find it a bit difficult to invest here, and there has been very little investment. So you have Japan, a country that invests a lot outside, but receives very little investment inside. Now, this is in sharp contrast to other advanced countries like the US, UK, Germany, and France. All of those countries have big stocks of both inward and outward investment. The investment goes in both directions. Now, Japan's restrictiveness on inward foreign direct investment is actually depriving it of an important source of economic dynamism and productivity growth. The government is now talking about trying to attract lots more foreign investment, but it hasn't had a lot of success in doing so. But as we're thinking of how Japan can become more dynamic, how Japan's productivity could rise, attracting more inward investment is an important part of it. Now, in December 2012, the Liberal Democratic Party, LDP, it's a right-wing party, was re-elected as the government of Japan. And Mr. Shinzo Abe is the head of the LDP, was the head of the LDP, and was the Prime Minister of Japan, elected in December 2012. Now, when he came into power in 2012, Japan had suffered 2 lost decades, suffered from the global financial crisis, and was worried about its future with this strong China next to it as a big neighbour. Japan faced, from an economic point of view, 3 big problems: low productivity, ageing population, and enormous debt. So Mr. Abe determined to revitalise Japan's economy through a program called Abenomics, obviously named after him. Now, the Abenomics program has 3 arrows, and you can see in this cartoon Mr. Abe with the 3 arrows in his bow. The first arrow was easy money to try and kill deflation. Remember, for much of the last a couple of decades, Japan had had falling prices, deflation. So arrow number 1 in the Abenomics program, easy money to make prices move in a positive direction, have inflation. The second part, the second arrow of the Abenomics program, was fiscal or budget policy to get government debt under control. You recall also, Japan has the world record for government debt, and so part of the Abenomics program was to get this debt under control. The third arrow, structural reform, revitalise the economy and revitalise productivity. Again, remember, Japan's productivity about 25% lower than the average for the top half of OECD countries. What do we mean by structural reforms? This means things like womenomics, giving greater opportunity to women, trade and investment liberalisation, robotics, increasing fertility, corporate governance, immigration, many more. Over time, in fact, Abenomics came to embrace almost everything. This, in fact, is good because Japan needs lots of reform across the whole range of its economy. Now let's look at the first arrow of Abenomics, monetary easing, easy money by the Bank of Japan to kill deflation. Now, the Bank of Japan's goal was to achieve 2% inflation within 2 years. Now, as we see in this chart, what's happened is that for most of the time of the Abenomics program, prices are higher, inflation has increased, inflation is positive or has been positive for most of this time, but the 2% goal has not been achieved. So we can give Mr. Abe a B+. He has mostly killed deflation, but he hasn't quite achieved the goal of 2% inflation. Prices are higher, but not as high as we want them to be. Another effect of the easy money is that the yen exchange rate has been pushed down. It's much lower. This has improved profits for big exporting companies. They're very happy to see a weaker yen. Workers' incomes haven't increased much, though. This has also been one part of the reason why Japan has had a massive increase in foreign tourists. Foreign tourists coming into Japan find it cheaper because of a lower exchange rate. The second arrow of the Abenomics program, consumption tax increases in an attempt to reduce the government budget deficit and debt. Now, what's happened is the government has increased consumption taxes a couple of times. This has actually had a negative effect on the economy. But at the same time, the government has continued with stimulus packages, which only increase the debt. And through the coronavirus, the government has also been stimulating the economy. The bottom line is that Japan doesn't have a serious plan to bring its debt under control. And so we see here again this chart of Japan's government debt, the highest in the world. And the OECD, this economics organization in Paris, they've calculated that if the government doesn't actually do anything to try and control debt, public debt could equal 600% of GDP by the year 2060. Of course, this is because we have this aging population, that more and more old people who require healthcare and pensions, and also a declining working age population, which means the economy is just weaker and weaker. Now, I'm sure that before we get to 600% of GDP in the year 2060, something is going to explode in the Japanese economy. That could be the exchange rate, it could be other things. But anyway, Japan has a big problem with its government debt, and it's clear there from that chart, but the government doesn't have a serious plan to bring debt under control. Now, the third arrow of structural reform. Actually, many people criticize Mr. Abe for not doing enough when it comes to structural reform. This is critical, of course, for improving Japan's productivity. But in fact, many things have been done. Not as much as we would like, but many things have been done, and some progress has been made. Trade and investment liberalization, which we'll look at soon. Japan has played a leading role in things like the Trans-Pacific Partnership, free trade with Europe, and so on. Womenomics, the government has been pushing for women to have a stronger role in the economy. Robotics, increasing fertility, corporate governance, immigration. There has been some progress in most of these fields, but as I said, not enough. Now, thanks to Abenomics, there has been some increase in Japan's economic growth. You can see here in the chart that from 1997 to 2012, Japan's GDP growth, this is the GDP growth rate, was quite a bit below the OECD average. But for the period 2012 through to 2018, which is basically the period of Abenomics, Japan is a bit weaker than the OECD average, but pretty close at the same time. So Mr. Abe has actually achieved something. There is a positive impact there, but Japan's fundamental problems are still not solved. Inflation remains well below the 2% target. It's not high enough. Public debt is not yet under control. Productivity is still weak. And looking ahead, Japan's population and the economy will shrink by about 25% over the next 40 years. So we have this shrinking population and shrinking country. And so what this means is that Abenomics needs to be reinvigorated. Abenomics actually is a very good program. It has all the right elements, all the right things. And if it were implemented seriously and aggressively, it would have probably very, very important effects. So what we need is more Abenomics. The new Prime Minister, Mr. Suga, he's keen on Abenomics. He was a close friend of Mr. Abe, and so he's continuing with it, but in typical Japanese manner, not aggressively enough. So this brings us through to the period of COVID-19. It's about 1 year since COVID-19 emerged in Wuhan, China, and Japan has been hit hard by the virus. So in our next class, we're going to look at the impact of COVID-19 on Japan. And of course, COVID-19 is hitting Japan at a time when the economy has been weak. And so this is one reason why we all need strong economies, because there are always surprises, always problems occurring in the future. You need to be strong. You need to be resilient so that when the bad things happen, you can cope with them. So thank you once again for joining me for this lecture. Arigatou gozaimasu. And if you have any questions, comments, reactions, please just send me an email. I'd be delighted to receive it. Also, of course, in the middle of January, when we have our student discussion sessions, we can talk about this together. And so for the moment, I'd just like to say sayonara, and I look forward to seeing you next time.